Hi guys, how are you? Welcome to our channel. My name is Freyman. I am an IRS enrolled agent, and today I wanted to talk to you about a couple of really cool tips for business owners. I think you'll find these useful. So first I wanted to tell you a little bit about something called the borrowed funds rule. And what that is you can claim a tax deduction, so it's a deductible business expense, when it's paid by somebody else on your behalf. So, and it can also be a deductible personal expense. So for example, in the case where your father decides to be really generous and pay for your mortgage interest for you, you can deduct that on Schedule A. Or if your father decides to pay for your business expense and buy something for you, that's a deductible expense. If, for example, your family decides to buy you a subscription to a trade publication for Christmas, that's a deductible business expense. That's called the borrowed funds rule, and that's just something you should know about and bring it up with your accountant at tax time or before. And then another rule I wanted to talk to you about is called a Cohan rule. Now what that is, it stems from a Cohan case from about 7 years ago. But what it means is that you're allowed to use estimates in many situations. Now it's not advisable because it could cost you money, but if there was a case where you clearly spent funds on something, but for a business expense, but you didn't maintain good records and you can't access those records. So something where it was used for business, but you have no proof, in most cases, you'll be allowed that deduction. You'll be able to deduct that. Not in all cases, but in most. The drawback to that is you may not be allowed the full amount of the deduction. So for example, if you were to say, I use my cell phone for business and I used it 85% of the time or so, but I'm not sure, I didn't really maintain any records, and if this was pulled into an audit or a tax court, that estimate would be allowed, but they will shave it down. So they will probably say you can use 60 or 75% of the bill for business where you thought it was 85 or 90. So they'll cut that back because you don't have any records to support that, but it's better to be able to get something than nothing. For example, what if you purchased materials that you were selling and you have no record of how much you paid for purchasing the materials? Well, clearly you didn't sell. The selling price is not your entire gain, right? So you should be able to deduct something for the materials. So we would look at what's a typical cost of those materials, what would somebody else pay in the market for that, and we should be able to use that for a deduction. Now, there are some notable exceptions, one of them that I really wanted to stress to you. So you cannot deduct charity without an actual receipt. There's no estimates allowed. Cohan rule is specifically disallowed, so there's no charitable deductions. And also very, very important, you cannot estimate your business use of auto mileage. So that's something you must maintain a log. You can't just estimate and say, hey, I think this is about how much I spent on driving last year for business. You actually must maintain a log. You have to have records of what you spent. Now, if you have those records, great, that's a business deduction, but you cannot use Cohan rule for deducting your auto business mileage. So very important, make sure that you keep track of your business miles. All right, so the next thing that I wanted to bring up is the use of effective dates. So if you're buying or selling a business or doing any kind of major transactions and you wanted to backdate it, so you cannot sign as a backdated date, but you can agree on an effective date for your agreement. So for example, you're selling a business and you're going to actually sign all the paperwork in February, but you wanted to sell it as of January 1st, so you don't receive the K1 from the business. You wanted last year to be the last year you filed it. When you're selling the business, you can actually agree with the buyer on the effective date. And as long as you put down that you both sign that effective date is January 1st, even though you're signing this in February, and you should sign with today's date, that's a requirement, you must sign today, you can't backdate dates, you can still choose an effective date that's a different date. In some cases, it's very useful. Now, there's one more topic that I'm going to talk to you about today, and that is taking losses on inherited properties. So, let's say a parent died or an aunt died, and they left you their home. Now, you have your own home, you have no intention of living in that home, and you want to sell it. So, let's talk a little bit about basis first. What's basis? So, let's say your aunt, she was in that home since 1960s. She bought it for $30,000 back in the day, and now that she passed away, that home is now worth $400,000 in the market. You can sell it today for $400,000, right? So if she had sold it, she would basically say, what's her gain calculation? She sold it for $400,000. She paid $30,000 for her home. We adjust for some improvements and selling expenses, but she would have a hefty gain. And after her Section 121 exclusion of $250,000, she would still be looking at a hefty capital gain on this property. Okay. Now, at the date of death, the home goes through a step up in basis, and what that means is whatever that home is worth in fair market value in the market on the day of death, or there's also alternative valuation that's not complicated, it could be 6 months later, but let's say date of death, that house is worth $400,000. When you inherit it, it now becomes a $400,000 cost of the home. Now you turn around and you sell it for $400,000. Seems pretty closed case, right? You're done? No. So here's the thing. Now you have this property that is worth $400,000. Your basis in it is $400,000, and you sold it for that market value. 2 months later, $400,000. First of all, it becomes investment property in your hands. It's no longer a primary home. Now it's investment property. Now you had to pay a realtor $30,000 in the sale of your home between the realtor and the transfer taxes and similar selling expenses. While you sold a $400,000 basis for $400,000 minus the selling expenses, you lost $30,000. That's a capital loss that you can take over the next, offsetting other capital gains, or $3,000 a year for the next 10 years, offsetting that capital loss. So, and it's going to be a long-term capital loss, even though you only held that house for 2 months or 1 month before selling it, because you inherited that property. So here's a way where you can actually get a tax loss that you can apply against your other income without doing anything. You sold it at the same price that you inherited it at. Okay, so that's a really cool trick, and I wanted you to know that. Hope you found this useful. Give us a like, subscribe, and we'll see you in our next edition.